Thank you all. Thank you all for coming. Thanks to Buzz and NAAHL for inviting me. My name is David Erickson. I'm with the Federal Reserve Bank of San Francisco. We're going to talk about health and housing on this panel. I should say before I start that these views that I may share with you are my own, because I say a lot of crazy things, and not representative of the Federal Reserve Bank of San Francisco or the Federal Reserve System. I'm going to do a few kind of opening framing comments, and then I'll give you a quick introduction of everybody who's on the panel here. These are people who you really need no introduction. You probably don't know John, so I think he is somebody who needs an introduction, so I will introduce you to him. But just really quickly, what I wanted to say was couple ideas. One is that we spend about $3.5 trillion a year on medical care costs, medical care services rather, in this country every year. 85% of that is for chronic disease. Most chronic disease is avoidable, and most chronic disease that's avoidable is generated in low-income neighborhoods. So that's, to me, seems like a real opportunity. This is like the cold fusion of like community development finance. If you could get that $1 trillion that's being misspent now for downstream chronic disease, and you spend it upstream for affordable housing and making every neighborhood opportunity rich, we would be in a much better place as a country, as a society, as a world. So that's one idea. The second idea is there's a researcher in Pittsburgh, his name is Sheldon Cohen. He did a research study looking at how susceptible people were to, the experiment was he infected everybody with the cold virus. So he shot the cold virus up people's noses, and he was trying to figure out some people are very susceptible to colds and some people are not. And the one most powerful distinctive characteristic between those who are vulnerable versus those who are resilient was whether or not their parents owned their own home between ages 0 and 5. So it's just kind of a wild circumstance. It didn't matter what circumstances they were in later in life. They could be wealthy in their adulthood, doing quite well. It still mattered that somehow in early childhood, their living situation got into the cells of their body, right? So you may not think, those of you who are in the housing business, you may not realize you're in the health business, but you are. So those are the two ideas I wanted to sort of start this conversation with. I'm going to go through quick introductions. I won't go into everyone's background because that's in your packets. I'm going to ask those who have the microphones, though, who are running those around, to be ready, because after I introduce everyone, I want to get 3 or 4 questions from the audience, just because I want to get a better sense of what's on your mind, so that will help frame some of the comments from the panelists. Okay, so now the panelists. I'm so excited about this conversation because it's just such a great group. So first you have Kimberly Cornett, Managing Director of Social Investment at the Kresge Foundation, and just like an architect of this whole movement, and has her sort of fingerprints on so many of the sort of vanguard ideas and vehicles in this space. You think about something like the Healthy Futures Fund that was co-locating housing with medical care, with federally qualified health centers. That's really Kimberly's idea from way back. The Strong Families Fund, this idea that somehow could you incentivize affordable housing developers to do something that it works on, to add to shelter some other service in their properties to work on the upstream social determinants of health, and could you provide some kind of an incentive through the fund structure to make that happen? And that was, again, one of Kimberly's ideas. So we were very fortunate to have her creativity in this field and on this panel. Next is Joe Flatley, President and CEO of Massachusetts Housing Investment Corporation. And again, like storied career, billions of dollars invested into low-income communities, affordable housing, commercial real estate. But one of my favorite sort of contributions of Joe's to this movement, to this conversation, is a product called the Healthy Neighborhood Equity Fund, motivated by its powerful question, which was, why is it that I can invest in a company that makes a pill that lowers blood pressure, but I can't invest in a neighborhood or housing that does exactly the same thing, right? So this is like a powerful, so thank you for your contributions, Joe. Kim Latimer-Nelligan, president of the Low Income Investment Fund. Congratulations on your promotion. This is all very exciting.
Thank you.
Kim and the Low Income Investment Fund has been, again, another sort of pioneer in this movement, and I think about the sort of work that she's done to sort of find ways to finance the bringing together of these two worlds and how you can sort of bring banks and banks and hospitals and health insurers together to invest in the upstream social determinants of health, like housing. Kim's was really sort of the moving force behind a report on health and housing with Mercy Housing a while back, which I still think is the best source to sort of discuss, really chronicled a lot of these efforts, things like the United Healthcare investment in Chicanos por la Causa in Arizona that's been just really fundamental in terms of this idea that we could bring health dollars into the affordable housing space. So thank you, Kim, for your leadership on that. And John Vu, Vice President at Kaiser Permanente in the Community Health Group. And Kaiser Permanente is a really interesting organization. Many of you are familiar with their $200 million investment through enterprise to finance affordable housing, clearly on the vanguard of these issues. Bernard Tyson, the CEO of Kaiser, just says flatly, look, we are in the medical care business, but we're also in the caring for our policyholder business. We co-own the problem of things like housing. So to have a CEO like that, a physician, talk about the need to invest in affordable housing, the need to attack homelessness is really powerful. Just to give you a sense, like Kaiser's not even that big of a player in the health space, and their revenue was, at my back of the envelope calculation, is double the net equity from the low-income housing tax credit, new markets tax credit, all the block grant programs, and all the other funding programs for community development finance. So if you can tap it, to talk about cold fusion, if you can tap into their funding sources, you're on the road to something pretty exciting. Another thing you may not know about John, I'm going to say one personal thing about John because he's new to many of you. He was born in Vietnam. And his father was in the South Vietnamese Air Force, and when the North was beginning to had overwhelmed the American forces and the South Vietnamese Army, his dad stole a helicopter, flew it to 3 different spots to pick up his extended family, flew the helicopter out to sea, got everybody onto the ship, flew the helicopter out and into the ocean, and swam back to the ship. So that is some tough stock right there. And so just so you know who you're dealing with. So that's our panel. I'm super excited. We've got a little bit more than an hour to talk to you, but I did want to get just really quickly, and I'm not sure where the mic runners are, but I want to just get like 3 or 4 questions, and I'm going to ask you to answer that question, ask your question in under 30 seconds. So if you just raise your hand, what would you like to hear from this panel? And it's very bright lights here, so we can't really see. So I have 2 hands over here and 1 back there. Okay, so let's start here, and then we'll go there second, and then we'll come back here third, and we'll come back to Corey for 4. Yeah?
So the connection between health and housing is often framed as a dual pockets problem. And one thing I've observed for a long time is that we see the logic, hey, we should connect these 2 sides of the issue, but everyone's really afraid of someone else putting their hand in their pocket, right, in someone else's pocket. How do we solve that problem? How do we overcome it?
Good question. All right, I'm going to go over here. Second question.
Josh Silver, NCRC. Real quick, lead in the paint, Baltimore, Freddie Gray, and lead in the water, Flint, Michigan. It'd be wonderful if you all talk about that.
Great. Third.
David Lipsetz, Housing Assistance Council. About 20% of rural hospitals are on the brink of closure. We've already lost 100 approximately since 2010. All the leading indicators for mortality are higher in rural places. How is your solutions going to impact rural communities compared to today?
Wrong pocket, lead, rural. Last question.
Corey Carlisle, the American Bankers Association Foundation. So many of us are here. We had a panel earlier on Community Reinvestment Act reform. Many of the lenders here are dominated by that. We have a health professional here that has to have community benefit plans in all the markets they have. Is there anything to be learned from those intersections?
Great. Well, we might take that question as a transition to you, John. We'll start with you, and maybe you could answer Corey's question just to get us going.
Gosh, I wish the audience had harder questions for me here. I'm already squirming. Thank you for the introduction, David. I think I should bring him everywhere to introduce me. It's like, then that's the most public that story, my personal story, has ever been, which is totally fine. I just don't expect me to be as tough as my dad or be as heroic as what he was able to pull off. And I'm happy to be here. And I think David really framed the nexus really well here, and the different pockets, wrong pockets thing also highlights that. And I'm glad to be categorized in the trillions of dollars that's misspent representing that sector here. But I think that's the very point of how we come to this as Kaiser Permanente. And for those of you who don't know, we are a fully integrated healthcare and health plan delivery system. So we have an insurance and a fully, hospitals and medical offices with physicians and pharmacies and labs, all fully integrated. We're in about 8 states and Washington, D.C. here. And we currently cover 12.5 million lives across that footprint, with about $80 billion in revenue a year. Not quite as big, healthy margins off of those revenues, but we make enough just to kind of keep things going. And more and more, our mission has always been, since our founding, health. But we've always operated as a healthcare company. And so, when healthcare, you're thinking about all the diseases and all the chronic issues and all, but even that David described. But even in that, at least in our history, we've gone up a little bit upstream in thinking about health education, prevention, and driving all of that. And as a fully integrated model, we're financially incentivized actually to keep people out of our system. We don't get paid more for the next procedure. We're not getting paid more for every visit. We are incentivized to kind of keep people healthy. And as we looked over the last 20 years, what does that really mean? How do we really fulfill that mission of producing health and not just doing more health care? That's when progressive leaders like our CEO and our board and senior leaders in our organization said, it's time to look beyond our 4 walls. And what are the conditions that are driving those issues in health or ill health? Many of you probably heard the term social determinants. And those are the social and economic conditions that are really shaping people's lives. Do you have a job? Do you have a safe, sustainable place to live? What's your school like? Is there safe places to go outside and walk? And all of that. And as David mentioned, those disproportionately affect communities of color, low income, and the equity is all that. So despite being kind of regarded as kind of top quality, #1 in NCQA ratings and all of that, and being a world-class provider, there were still uneven outcomes in our communities. If you look at a map of, say, Oakland or DC, you've seen other maps that show the life expectancy differences between different metro stations, different BART stations, different exits off the freeway along the Inland Empire, on and on and on. So something deeper than just good medical care is going on and whether people have insurance. And that's really, I wanted to kind of set that up as the deep motivation behind why we're getting into housing and a number of other issues like food security and a broad array of people's social needs. And the sort of infrastructure and tools that we want to build as a system for the 12.5 million people that come to Kaiser Permanente every day for their care, but also for the 68 million people that live in the communities that we serve. And so part of that obligation is this community benefit obligation. As a not-for-profit healthcare organization, just like banks have the CRA obligation, we have a community benefit obligation. And we're only beginning to kind of scratch the surface on this and dabble into this. I think we've done a lot of good sort of chronic disease, obesity issues, and ventured into kind of the place-based interventions. But in the last year or 2 or so, we've really been talking to our treasury and our finance departments about how do you redirect some of these big investment holdings that we have towards more social impact while getting a financial return. And then how do we start having the conversations with the banks about this to kind of partner and invest together. So we haven't figured this out. We will continue to kind of direct our community benefit spending, but we know it has to go way beyond that. All the other assets that we have, like the treasury holdings, but also in the way we hire in our workforce. the way we purchase and procure. We buy about $20 billion of goods and services every year. Can we think about directing some of those to local and minority-owned businesses, for instance, and drive local economies that way? We think about our hiring, purchasing, investing, all of that as a collective coherent strategy now. And now we're getting into the housing space, which admittedly, we knew nothing about. I mean, none of us own buildings and properties inside, but we're finding good partners like Enterprise or LISC, or talking to groups like LIF about other investment kinds of opportunities. So it's kind of a big setup, but I wanted you all to kind of get a sense of where we're coming from in terms of this mission of health, and we're seeing the connections between all these other issues in people's lives and how it affects health. And if we're really truly going to produce health and make it good for our business, because healthier people is good for our business, we have to go out venturing this way.
Thanks, John. Kimberly has a lot of terms or phrases that I don't understand, but she was saying, like, this is the bunny I'm chasing. And one of the bunnies she's chasing is just what you mentioned about these reserves that you have and the sort of the investment dollars that are, at the moment, just being invested in some kind of portfolio management sort of strategy, but could be invested in things that actually improve the upstream social determinants of health. So I wonder, Kimberly, if you can touch on that. I'm going to come to you next to kind of do a 5-minute opening, but maybe talk about that, and if there's any one of the other 4 questions you could kind of tag too, that'd be great.
So David is always really generous with his openings, and it is true, I did work on those deals that he mentioned, but what he doesn't mention is how long and hard and messy they are, and how they go in fits and starts, and I'm fortunate to have many partners here who have walked those journeys with me. If I had either more time or more creativity, I've always wanted to write a paper mapping the evolution of how the affordable housing industry adopted green practices along the path of how we're adopting health. And I consider kind of my formative days when I was in the tax credit business at Enterprise, and I remember a lot of Enterprise alumni here. I remember Bart Harvey coming to my office, and he had gone someplace and really gotten religion on green. And this was before, green was a thing. And he wanted me to go out and raise $25 million of specially priced equity to fund this thing, and I thought he had like lost it. But we ended up scraping pennies actually out of a Freddie Mac fund that Chris Hobbs was running at that time. But over the years, what Enterprise and many others did was really understand what were the policy levers that needed to be pulled to make green and affordable housing work. What were the financing options? How did you measure the savings? What were the social impacts? How did you communicate that to the regulators? And there was a whole series of steps that we took as an industry to make that adoption happen. And for those of you that are out, banking developers or financing tax credits, those are probably rote things that you value. And we're on a journey with health right now, really understanding what those drivers are that we can both monetize in terms of how we finance things, but also, what the ancillary and adjacent impacts are for the people that we're trying to serve. So I'll just expand upon the one thing that David mentioned, which is the bunny that I am chasing, and only really have 3rd grade fluency. John unfortunately heard this speech yesterday in Cleveland. But somebody mentioned Chicanos por la Causa in Phoenix, who is in our portfolio. I was visiting with them a couple of years ago, and we were on a drive-by tour, and they happened to mention that they had just bought this building, and they were putting some kind of high utilizer patients in there. And I asked the obligatory questions, where'd you get the money? And they said, well, United Healthcare gave it to us. And I asked, the next question, obligatory question is, what are the terms? And they were pretty extraordinary terms, and so I got more interested. And the amount of money that United invested was not a significant amount in terms of the scale of United's business, but the terms were such that it definitely piqued my interest. And so what I came to learn and have been really trying to understand at a more granular level are these things called risk-based capital, which health plans have to hold. And right now, and this is a layperson's description, it essentially is 200% of your outstanding amount of Medicaid claims. So if all your Medicaid claims came due tomorrow, you needed 200%. Those are held in liquid-based reserves. And so when you look across health plans in the United States, that is a massive amount of money. And so many of our borrowers have been really focused on community benefit dollars, but in the scale, when we look at kind of at-scale sources, I am cautiously optimistic that this is one. It will be a messy path to figure out how we build both the education and the receptivity and the experiments that may prove out that point or not. But eager to have partners like John and others to figure out if that's a possible solution for affordable housing.
Great, thanks, Kimberly. Kim, we're coming to you next for some opening remarks. And if you can, maybe think about the lead rural wrong pocket questions that are on the table. I don't know if they can work those in or not, but I'll let you go next.
Kim, not Kimberly. Oh,
Kim,
me. Thank you.
yeah, sorry. Yeah, sorry. It gets a little
Thank you.
confusing up here.
Thanks, David. So most people know LIF is a national CDFI. Capital is our primary tool, and so we have kind of approached this whole social determinant of health from the perspective of how can we find models and lift them up, and how can we play a role with our flexible capital to identify those models that could be replicated or scaled. David mentioned a report that we did with Mercy Housing with some support from Kresge and the Cal Endowment, and we kind of had a Friends and Family Advisory Council and went across the country and looked for models where there was some kind of, whether it was private or public, but some kind of health dollars supporting the creation of affordable housing. And in fact, the Chicana por la Causa project that Kimberly mentioned was one of those that we talked about in the report. And what we found, we were able to identify a number of barriers, and one of them is, to your question, the wrong pocket problem, in terms of having the health sector and housing or the community development sector work together. And one is the wrong pocket problem. And so I think of that in a couple of ways. One, to the extent that there are investments made in the social determinants of health, say housing, in the example of Chicana por la Causa and United Healthcare, the challenge is, depending on the number of insurers that are involved in that population, in that neighborhood, it could be that the benefits accrue to a different entity, a different health payer. And so some of the examples we found where there was traction was when there was only one health payer or two health payers. And that really, this country is all about competition. Competition drives down costs. But I think in the health sector, when you're trying to innovate, actually competition is not necessarily a good thing. And having fewer payers in a particular place can indeed promote innovation. And the other wrong pocket, it's not quite wrong pocket, but this notion that there is such pent-up demand for affordable housing and such pent-up demand for health services that even if you are able to do a Chicana por la Causa project, the actual savings from the public's perspective, unless they're seeing their budgets go down, unless the county health agency sees their budget go down, it doesn't feel like savings to them. So they may be taking the same amount of dollars and working with more people, more families, increasing the health of more of their residents. But if the budget's the same, and it is, because again, you have all those people, I envision people standing in line. The line maybe got shorter, but there's no true savings. And that's another challenge. And then one other that I'll mention is we've talked a lot about housing, and what Kaiser Permanente has done is really groundbreaking. But when I think of going upstream to the social determinants of health, I kind of think of housing as a creek on like a nicely sloping hill. because when you're investing in housing as a social determinant of health, particularly if you're doing it with dual eligibles, high utilizers of health care, you see those results of having them in safe, affordable housing with services fairly immediately. You can kind of quickly see, treatment costs are down, people are healthier, and that may be within a year or two. But then when you think of other social determinants of health, like I'll use early care and education as an example because it's something Lift spends a lot of time on, it feels a little bit more like Niagara Falls because investing in ECE has huge impacts, and there are so many studies that back this up. And while there is some immediacy in terms of lower special ed costs when children who have been through a quality program go to primary school, a lot of the upward economic mobility that results from going through a high-quality early care and education program, that's 20 or 30 years down the road. So, I don't want to lose sight of those other social determinants of health. Housing is clearly critical, but those other things, and we have to figure out a way to somehow, fast forward those benefits or think about those benefits more creatively, so that we're investing across the spectrum of the social determinants of health.
Thank you, Kim. Joe, you've put together a fund that combines, as investors in an equity fund, banks, hospitals, foundations, government, and I think private investors. I wonder if you can touch on that a little bit, because I like that we've, so far in the opening remarks, people have gotten into some deals and given us a flavor of something pretty concrete. So I wonder if you could just weave that in.
I can do that, maybe just quickly going through a few slides. But let me just say first, we've been around for 29 years and financed like 23,000 units of affordable housing over the years. And we've all, over time, we've gotten to be better at making sure that the housing we're financing is healthy in itself. Lead paint, asbestos, all of those issues. But what's become clearer more recently is how much neighborhoods matter for health. And I'm glad the panel is titled Financing Healthy Neighborhoods. It's not health and housing. It's typically people will health and housing. And then it's about lead paint and making sure the housing itself. But the truth is, neighborhoods matter a lot, and there's enormous equity issues. The number that really startled me was when we did a health impact assessment of this tool we were rolling out with the State Department of Public Health. And when you look at two neighborhoods in Boston, and they're on either side of the medical center, Roxbury and Back Bay, the difference in life expectancy at birth is 33 years.
Wow.
So if you're born in Roxbury, you're likely to live 33 years less than somebody born in Back Bay. Some of that has to do, obviously, with concentration of poverty and other issues, but that's kind of startling. And so that's kind of how, when we got into this and we're looking at financing some transit-oriented development, we worked with our partner, the Conservation Law Foundation, and you see a slide up there sort of going through it. It's hard for me to read that, so I'm going to look at my iPad so I can read what that says. But we started this a while back, 2013, 14. It took a while to assemble all the pieces, to work with the foundations, get everybody sort of lined up in the same way. When we started, we were looking to raise money from really social impact investors was the idea. And part of the notion is that, and this is part of our philosophy from the beginning, is this should be good investment. In other words, we weren't looking for philanthropy, we weren't looking for grants, we were saying investing in these kinds of developments should be good investment. And part of the reason for doing it is showing that it's good investment so other money will follow. So we're not just sort of trying to do what we're doing, but trying to show that this can be good investment. We're now sort of wrapping up this first fund, and I'll go through, this is the clicker, I guess. Go through quickly just to show you what we've done and how it's worked. How do I? There we go. There we go. This is a partnership between ourselves and another organization, the Conservation Law Foundation, which has historically been an environmental advocacy organization, but they've got into this health area because of the connection between the environment and health is also a very obvious one. And they're the ones who have really worked on the health impact side of this, and they put together a way for us to screen projects on two issues. One is to finance projects in areas where there is an inequity in terms of health. There's an area that has worse health than the area around it. And the second screen is that the project itself will actually improve the health in that neighborhood. And there's an interesting, if I go to the next slide, I think. This is, you're not able to read this probably, but this is the scoring process. The top part is around the neighborhood, and the bottom part is around the project itself. And we've road tested this through the first phase. And in terms of the healthcare investors, they're obviously very interested in this. We have confronted a little bit of an issue with our bank investors. We started trying to raise social impact investors, and we got a couple to come in, but most of our money that we raised really is from our banks, who've known us for a long time, have confidence in us, so they were willing to get involved in this. One of the questions that immediately came up for them was, does this qualify for CRA? And we've been working with them, and I think they basically have invested and will continue to invest so long as it qualifies for CRA. But that may be a challenge and something that we're going to need to work on. The next slide shows you the investors. This is 17 investors. The one on the left side are what we call Class A investors. We're projecting they're going to get like an 8% return on their investment. And then the right side is the Class B and C subordinate investors, which includes Kresge and Robert Wood Johnson. It includes some public money that we were able to get from the state. Northern Trust came in and made a loan against the guarantees from Robert Wood Johnson and Kresge. So sort of a lot of pieces to put together. Took longer than I'd like, and I think as we're talking about launching our second fund later this year, we want to short circuit that process and make it much cleaner. But it did ultimately work. We were able to raise $22.35 million, and you can see in a second. I'll show you the 7 projects we've closed, which is about $19 million. This is equity. This is economic equity which we're investing here in these projects. It's going to leverage a lot more than that. When we looked back and we're sort of looking at all the TOD projects around, the big gap in terms of getting them done was equity. So that's how we came up with this product. Altogether, the projects we've already financed, closed on, will create 552 new units of mixed income housing. And I'll go through and just show you a few of them. Chelsea Flats is the first one that we did. It was an investment of about $900,000. I'm just going to show them to you quickly so you can see the kind of projects. Trademark Building is a building where we're invested. This is, again, typical for these kind of projects. They're overly complex. First floor is ground floor retail, then there's 3 levels of LIHTC housing, and then 2 levels of home ownership. The top 2 levels, this is directly adjacent to a T-stop. The top 2 levels ownership are what we invested in. Landing 53, Braintree. This is a project directly adjacent to, as you can see, the commuter rail stop in Braintree. This was a neighborhood, sort of an older suburban working class neighborhood. I think there's more poverty and problems in suburbia than you would normally think. Most people think from Boston, Braintree, well-off community. Well, in fact, this was an area where there was significant health disparities, and this was a $5 million investment. One of the questions people have asked us is, how are we going to get out of these? What's the exit strategy? In the case of this project, the developer is very anxious to get us out, wants to know how quickly they can get us out. And so the projects that are successful, there's really not a problem. But the basic exit strategy, we are patient. It can take up to 10 years. But we can essentially force a sale of the property with us getting our equity proceeds. Bartlett Station in Roxbury is very close to Dudley Square, sort of in the heart of Roxbury. This is a mixed income, mixed use, mixed tenure, again, project. The challenge here, and this is really true for many of the projects that we financed, is the ground floor retail. As we've gotten into this, one of the things we've learned, one of the lessons learned, is both the difficulty and importance of ground floor retail. Ground floor retail is what makes a neighborhood walkable. It's what provides access to healthy food. It creates safety. It does all these things which you really want to see in a walkable, mixed-income neighborhood, but it's also the hardest to do. And as a result, one of the things we're doing with Kresge is we have what we're calling a Healthy Retail and Commerce Initiative, where Kresge is matching money that we get from hospitals to invest in this healthy commerce. And we're getting low interest rate money from Kresge, low interest rate money in this case from Boston Medical Center, who invested in the Healthy Neighborhoods Fund. And we're continuing to want to do that. And I think the communications with the healthcare system has been interesting. One of the things is we've been trying to raise money for them to invest in what we want, and of course they turn the conversation around to, well, we've got all these high flyers who are costing us millions of dollars. Can you do something about these people who just keep coming into our emergency rooms and you provide housing for them? And so we're working with them on trying to deal with their challenge, which is that those high-cost patients.
Can we tell the funny story about how far these worlds are apart?
Yes.
We won't name names, but I think whenever sectors are trying to figure out ways to work together, there is the necessity of building relationships and common language and an understanding of what the goals, objectives, and drivers are on each side, and sometimes that takes time. So I was on the phone with one of Joe's staff people the other day who was telling me about how negotiations were going on with one of the healthcare partners. And one of the issues was that the healthcare institution was questioning whether MHEC needed to make a spread and why that was actually necessary. And this person is sitting in the treasury function, so clearly, there's a basic understanding of finance, but only to say that, we're trying to make worlds meet that haven't before.
Yes, that's definitely true. But part of what we try to do is build the relationships, and then over time you sort of work through these things. But I think we will get there. But it is a challenge, really. Homes Beverly is another sort of suburban project in Beverly, but again, sort of an older working class neighborhood. And it was an area that really had health disparities, and this is a terrific project. We actually had our annual meeting yesterday and gave this project one of our Excellence Awards. Melody Residences is a project, again, mixed income project, mostly more market than constricted affordable housing, but part of that's what the neighborhood wanted. It is surrounded by public housing and 100% affordable projects, and what the neighborhood really wanted was more of a mix of incomes in the neighborhood. This is a project in Haverhill. This was sort of the missing tooth in a downtown revitalization. It's, again, ground floor retail with residential up above. Lessons learned here. Hard for you to read. Hard for me to read, too, actually. In the first fund, we raised a lot of subordinate capital. We were trying to have a bigger fund. We sort of cut that off in terms of the Class A investors, and so we really raised more subordinate capital, $7 million out of $22 million. Didn't need to be that much. 5 to 10% would have been enough. Our target return for investors, Class A investors, was 8%. That's probably too high. We're probably lowering our next fund to 6% because I think that makes a lot more projects feasible. We need additional low-cost capital for the retail, as I've talked about. We've got two initiatives. One is the Healthy Retail and Commerce Initiative. The other is we've got a neighborhood commerce fund, which we put together with some CDFI financial assistance money, which again sort of fit out loans. But financing that retail space is a big challenge and really important. We're going to be focusing more on housing affordability in some of these neighborhoods. We're transforming neighborhoods. In some cases, we're transforming them too much. Sort of have to worry about that. The health score, I think one of the things that was interesting in the health score is that the developers wanted to know what their health score was. They wanted to publicize their health score. So we hadn't even thought about that. We were sort of thinking health score is something we want to know, make sure we're making a good investment. Turns out they actually wanted to know so they can boast about what they're doing, sort of like a lead building. And again, finally, CRA is going to be really important to continue to get bank investors, and we're going to need to work on that.
Thanks, Joe. So lots to chew on here. I want to go down, I want to talk to each one of the panelists a little bit more about this key lessons learned. Were you in a cross-sector project that you worked on? What were sort of the barriers? What were some of the obstacles you had to overcome? What was easier than you expected? What was harder than you expected? So I'm going to go down the list. I'm going to start with John when I get to that question. But before I get to that question, I want to ask Kimberly a point that was triggered by something that Joe said about how it was harder than he expected to put that fund together. And you said it was going to be messy, and you're giving me the deer in the headlight look even now. So it's interesting that we have a few deals under our belts now. And one of the things I think might be kind of instructive for the audience is you just discussed phase 1 and phase 2 of the Healthy Futures Fund and what was different. What did you have to do it was a $200 million fund. The first $100 million, there was a certain set of characteristics that were necessary to get it off the ground. What got easier in the second $100 million?
So the Healthy Futures Fund we started working on right after the Affordable Care Act was passed. And on the program side of Kresge, we were making lots of grants to federally qualified health centers, which is a primary institution that serves low-income people and provides health care. What was expected was that about 30 million more people were going to visit those centers as they were coming onto the insured rolls, and that many of those FQHCs were not physically ready to accept that new patient volume. Because FQHCs primarily were funded through the federal government, they did not have really a history of taking on debt to expedite construction projects, and there simply wasn't any more of that free money. There was a little bit of CDFI activity in that space, but not enough, and so we didn't have enough grants, right? So we started trying to figure out how to build the knowledge on both sides of the equation about how CDFIs could finance FQHCs. And then we needed a senior lender. And so, it does come back to people getting to know one another. So our senior lender in the Healthy Futures Fund was Morgan Stanley. They had never even heard of an FQHC, and for the first 8 months would mix the letters up as we talked about them, and had never worked with philanthropy in terms of understanding what our guarantee looked like, how they would exercise against it. So it was really kind of the skunk works process of trying to put those pieces together and build people's familiarity with what the asset was that we were trying to finance. That fund, because of a lot of hard work, ended up being successfully deployed. And what we saw in round one was a couple of examples, one in Massachusetts, where the FQHC that we were financing actually was acting more as a community development agent in their community. In this case, they were partnering with a local grocery store that was serving an immigrant community with very tailored programming and food offerings. And so we started getting interested in how many more FQHCs are operating out there like that, and went specifically looking for them and ended up doing a second round that was really trying to lift up more examples. And I think a lot of the stuff that we end up doing is really trying to build, to say it's an encyclopedia is too grand, but small pamphlets of different types of deals and lift those up so that they can be replicated by others. So I think what got easier over time is that the partners were more comfortable with working with each other. Morgan Stanley got more comfortable understanding what an FQHC was. And to be honest, the whole CDFI field ended up kind of starting to embrace health centers as really kind of a new asset class, to the extent that we ended up from that because our credit enhancement was really no longer needed.
That's great. I mean, it's a good story about how it gets a little easier as you move on. And I think the point about language is really important. So, we've had, the Federal Reserve has partnered with the Robert Wood Johnson Foundation to do about 50 of these healthy communities meetings around the country over the last 8 years. And I remember in the early days, the hospitals would come and they'd say, would you please stop saying debt and equity and capital? Just say money, because we do not know what you're talking about, And I remember one point, someone was saying something about MRIs, and the guy leaned over. It was Kimberly. This was at the Board of Governors, and these guys said, "Why is she talking about a magnetic resonance imaging system?" So I mean, the CDC. You can see how these things go. We could go on and on about that, but the language really is important. The expectations are really different. What they think of in the health sector as low income is very different than what we think of as low income. The idea of should you get a spread or not, the expectations, the cultural expectations, some of the business practice is very, very different. Time frames are very different. And so we're getting better at it, and that's a good story about Healthy Futures Fund that shows that you can get better at it. So I want to go down, I want to get back to that question I asked earlier, and we're going to start with John. An example of a cross-sector project, what was easier, what was harder, what did you learn, what were the obstacles?
Yeah, we have a ton of those, and the language thing is completely, you were calling me out again as the person who's like, debt, equity, just tell me, what's money? So I come from the community health side of our house, and, going up a few floors to our treasury department to get them to start redirecting, that took years. That was one of the biggest challenges. They have this fiduciary responsibility to protect our pensions, make sure that we have enough to reinvest into our capital planning and our facilities and our IT and all of that, and protect the long-term sort of balance sheet. And we're saying, well, you could still do that, just take a little bit less, but look at all the upside on the social gains. they got it because they work at a mission-driven place, but they just could not break from their primary responsibility. So there was a lot of talk about that. And how we broke through that was we had to bring people from the outside in to tell them. We had to bring Goldman Sachs, who had been working on some urban investment plans, and say, oh, okay. We had to bring other healthcare institutions, competitors, friendly competitors, who treasurers from other places to tell our treasurers, you can do this. This is how we did it. So there was just this long, and then we brought fund leaders or CDFI leaders to say, and this is how we've been the brokers in between, and we could be the intermediary for you, so you don't have to become a property expert. You don't have to become a real estate expert in that way. So, I mean, I think that was some of the thing that broke through. And in my opening remarks, I spent so much time pontificating that I actually didn't kind of even talk about what we're actually doing. So just real quick, we've created a loan fund, a loan capital fund for $100 million that we want to make available to every one of our markets for affordable housing development. In the Bay Area, we have a couple specific special funds. We've got an equity fund for preservation of current affordable housing in the Bay Area, and we're finalizing a deal to work with LISC and a number of other coalition partners for a $500 million fund for Bay Area housing. That's going to run the gamut from sort of permanent supportive housing, veteran, family working housing, maybe even faith-based real estate development, so all of that. So sort of 3 primary funds right now. And even on the equity one, when we brought in our community health leaders to come in to be introduced to this equity fund, they got so excited, and they were hearing our partner talk about it, and they were saying, this is going to be great. It's going to solve all these inequalities. We're going to take on disparities. We're going to go into these places and look at heat maps. And the banking people were like, yes, but that's, and then we realized that they were thinking equity, like this fund is going to address equities in our community. And the bankers were talking, no, this is a fund about deploying equity capital. And so that was like 30 minutes into the meeting, we were like halfway through, and everyone was just talking past each other. So it's just stuff like that we finally got through. And now lessons we're learning, in our first investment from the equity fund, we acquired a building. We worked with an affordable housing developer, and we were all gung-ho. We wanted to be really public about it. Let's spark this movement and get going here. And kind of people were okay with it, and our CEO just kind of announced it and talked about it. Lo and behold, one big learning that who knew, but real estate is hard and messy. And there were all these seismic issues. And we're like, well, we were committed to this. We will put funding, whatever needs to be fixed and all that. But our partner was like, well, but we have to think about this from a due diligence, the investment, the risk around the safety, how we balance this with our other investments. And if it collapses, part of the fund is going to get wiped. And we were just like, we don't care. Like, we'll give you more grants. We'll do something to help the building or something like that. So it's, working through those kinds of things and sort of just how you deal with properties this way with some, a couple of examples of things like that. Out here in DC, we're working, I don't know how many of you know, in Maryland, they're going to extend the Metro line and add this purple line through a couple of Montgomery and Prince George's County. And there's a coalition that wants to think about the economic development and housing opportunities around all the different stops, as Joe was talking about, transit-oriented. So now we're part of this coalition, and we want to bring sort of the housing and neighborhood focus on it. And people keep wondering, what are you doing, or why? What can you contribute to this? And they're not totally getting that we've got this capital fund that can go into affordable housing developers. If you're ready, we've got low interest loans for you here. So that's kind of just some of the kind of like, what is KP doing here? Kinds of things.
That's good. I'm glad somebody else has asked that question. I was speaking at a maternal and child health conference, and I said, they couldn't find my name badge. I said, well, I think I'm the only person who's registered from the Federal Reserve. And they said, yeah, you're the first person who's ever attended this conference from the Federal Reserve ever, in 20 years of us holding it. So being the unlikely partner is sometimes has lots of upsides and pitfalls. Kim, you in our call getting ready for this, you had talked about some of that you've been mapping a lot of the different sort of areas of where there's agreement with the health partner, where there's some gaps, where there's some real sort of even conflicting goals. I wonder if you can talk about a project that sort of gets into that a little bit and maybe talks a little about this idea about what was easier, what was harder.
Yep. So, and I might go back to my, here they are. I'm going to skip forward. LIF feels strongly that in terms of moving the needle on poverty and also health, when one is able to comprehensively coordinate and invest in multiple social determinants of health in one place, that you get better results. So addressing the people side and also the place side. So not just housing, but as we've talked about, housing and schools and safe sidewalks, transit. And so we have spent a decade investing in projects related to comprehensive community development, and they are most often effectively led by community quarterbacks, a term you know well, David. And in that way, they're evidence-based, they're intentional, and they have a community voice, which is really critical. So a number of years ago, we, asked our community quarterbacks, what else do you really need? What else is really missing from a capital perspective? And what we found was that enterprise-level capital for the community quarterback was most often identified as the missing piece. In other words, they could generally, the systems aren't perfect, find capital for affordable housing or find capital to finance a charter school or find capital perhaps to acquire land. But when it came to kind of running their shoestring operation as a community quarterback, as a nonprofit, or a lot of the work they did depended on philanthropy for equity. So their development would be very linear and slow. So they would raise some equity and then build some housing and then raise equity and build a health center. So they thought if there was a way they could bridge the equity and recycle it, that would be super helpful. So what we did was create Equity with a Twist. We took our FA award, which Lisa was talking about earlier, how important that funding is for CDFIs. And we took that and then matched it with a grant from the JP Morgan Chase Foundation and created a $6 million pool as a pilot for Equity with a Twist. And we invested in comprehensive efforts with TCB, I don't know if TCB is here, in Avondale, with a purpose-built community in New Orleans, and with Bridge Housing in one of their rad redevelopments in San Francisco, Potrero. And they all used it differently, some to bridge philanthropy, some to Bridge actually hired a community development coordinator and knew that they could fund it when the mixed income housing, when the market rate housing kicked in, but that was 6 or 7 years down the road, so we allowed them to do that today. And what we wanted to show investors was you could have high social impact. So in other words, the communities, and I didn't mention this, have to do mixed income housing, have to do early care and education interventions, and have to do quality K through 12 education. So we wanted to say, look, if in a coordinated fashion in a place, you were thinking about and investing in all of these assets, and sometimes others, but absolutely these three as a minimum, you could see, we asked them to measure health impact, the health of the community, education impacts, economic viability impacts, and we wanted to be able to prove to investors we have this impact and there's a modest social return. So for this, 10 years, very flexible, and a 2% return. Below market, but again, high social and absolutely a return, so not grant capital, but a modest return. And so that has been successful insofar as these communities have demonstrated marked increases in the feeling of safety, in health, in third grade reading scores. And so we're doubling down, and version 2.0 will be rolled out with purpose-built communities and a debt fund we're raising with them. But to your point about the cross-collaboration, capital to support those efforts, because that's not asset-based, it's really enterprise-based. One other example I will give is SPARK, which is Strong, Prosperous, and Resilient Communities Challenge. 6 communities, 6 places, very robust, community-led, cross-sector partnerships. The idea here is allow the community to think about how they want to invest in their built environment, do it in a way that reduces racial disparities as opposed to the system that's been in place for so long that often increases racial disparities, and also create a culture of health, a community of health, as opposed to the other way, which is often, unfortunately, reducing health impacts. So here, some good lessons about cross-sector collaboration, and Kimberly knows some of this because Kresge's a funder. This was a 3-year program. We're entering the 3rd year. It has taken some of these tables years to form, and all doing the right things, very focused, but I can think of Memphis, for example. They are still entering year 3 and bringing the health folks to the table, the public sector folks, the housing developers, the community advocates, the tenant advocates, all of those stakeholders, because this is really meant to be driven by the community. It has taken a tremendous amount of time to create that, to build that trust. And then one other challenge is really how do we get more creative, thinking about forms of community ownership of assets. There are some models out there, land trusts and other things, but we need to be more creative, more innovative in thinking about how again, we talked earlier today about displacement, how we can keep the wealth and the income in the community while you're also increasing health impacts, increasing education, et cetera. So the cross sector is so important, but lots of challenges.
Kim, thanks for that. And it's as John, as you said, real estate, turns out real estate is hard, medical care is hard, investing in an ecosystem way, the way those 2 examples you just gave us, Kim, that's even harder, and I'm just so proud that we have examples of us doing it, and I just hope that we can kind of follow the Healthy Futures Fund sort of rule, which is that it'll get easier as we continue to do it. One question I have for the panel before next is this, a deal that you really would like to do but can't, and some of the obstacles to that. Kimberly, I want to ask you to go, but I'd also like to get another burst of questions from the audience. We haven't really circled back on lead yet. That's the one I think that's still out there. But if those with the mics can just sort of keep an eye out for hands, it's kind of hard to see from here. If you raise your hand if you've got just real quick 30-second question. We have one up here in the front, and there were 3 on this side. That was quick, good. And one over here. Why don't we try this one here first?
What are your thoughts on where you might have some asset sharing for the community? What fields do you think may be possible?
Great, thank you. Over here.
Ann McCulloch, Housing Partnership Equity Trust. Is there one data point that each of y'all would use to say this is success for what we're doing?
Helpful. There's back here.
Tamara Greenspan with NeighborWorks. I'm wondering, we're talking about all the benefits of integrating systems. Are there things we should be concerned about integrating systems? Are there kind of monopolies, bad actors that we want to stay away from?
Great question. Last question here.
Can you stand? Sorry.
Priya Jayachandran, National Housing Trust. For John, a question that Kim really raised about when you have multiple providers or payers, we own about 1,000 units in Washington, D.C. We're working with the dominant Medicaid managed care organization to try and provide community health benefits. One of the things that we're struggling with is not all of our residents align with their policyholders, and they're legally not allowed to serve people who are not their policyholders. And we struggle to provide services only to some of our residents and not to others.
Wow, those are great questions. I'm glad we got those on the table. And I may withdraw my question just because I think those were better. So, panelists, who wants to go first on this?
What was the question about assets? I kind of missed that one.
Here's a microphone.
Where are some possibilities for asset sharing? I realize that there are not too many role models, but in terms of thinking outside of the box and trying to identify some areas, what would you suggest?
I don't know if I have a suggestion. I actually have more of a lesson being learned right now. These partnerships are hard, but they're already set up to be successful because they're transactional. We have some money, you have a service, here's some money, help invest it. There's long conversations that go on and on. What gets harder, some of these things have to be tackled region-wide or, from a multi-player, multi-sector standpoint. And those partnerships, we haven't been able to crack through. So, I'll take an example. In Seattle, Microsoft is terribly interested now in affordable housing. We are up there also. And we've met, but they've got their framework, we've got our framework. We all have these great assets that we want to get out there, but we'll just kind of stay over in our different parts of the sandbox. In a place that's highly motivated, like San Francisco, the Bay Area, where companies like Cisco have dived deeply in, Salesforce, and they're all buds. All our CEOs are buddies, and they've been talking. They said, we got to tackle this together. Meanwhile, well, we want to kind of do it this way. We kind of want to do it that way. Well, how do we kind of throw all our assets into a pot together to take this on? And we thought affordable housing was too easy, so we wanted to take on homelessness too. And on the homelessness issue, they've at least got together to say, let's at least commission a report. And the report, lo and behold, says this needs to be tackled as a region-wide issue. And Oakland can't do it this way, Berkeley can't do it that way, San Francisco can't do it this way, because people kind of move in and out, and you're sub-optimizing the housing availability, all of those issues, the VA support, all of that. Meanwhile, all these companies, we're all still trying to do this dance and figure out how do we play together. So, that's not very helpful advice yet, but if you're thinking of just calling, Clorox is down the street from us, their headquarters in Oakland. We haven't even picked up the phone to call them yet, as examples. That doesn't mean we're not trying. JP Morgan came, and they want to do these big Healthy City initiatives. And we are also, we've shared our frameworks, and we've shared our approaches, and we'll just keep talking. We'll work this out eventually. But I'm hopeful that we'll kind of be all in the same sandbox playing in the same way. But these things, as big corporates and big employers, it's just kind of hard.
Thanks, John. We've got about 11 minutes left, and I want to save 4 minutes to give each of you a minute each to give a last word. So who wants to go next? Maybe Kimberly.
So I have a deal that I can't do, and I have a deal that we're doing that I would be not doing my job if I didn't advertise that we're looking for capital for, so I'll take this opportunity. In Detroit, there was a private college that was in the middle of a very dense, low-income neighborhood that, if you know Detroit, was having a hard time hanging on anyway. The college, it's a long story, but the college was failing financially and was at risk of closing. And we aggregated a massive amount of grants, which is why it will probably never be done again, in order to purchase, and some PRIs and guarantees, to purchase the assets of the college and essentially put the real estate into a nonprofit conservancy so that it can be redeveloped for a variety of community uses. And the thought there, which I give Rip Rapson all the credit for, was that he really recognized that if the college went dark, the surrounding neighborhoods were going to fail as well. I've shared this work with Kim. It's on my kind of, I don't know, wish list if I'm a billionaire someday, that there are so many colleges that are going to fail as higher education shifts. And some of those assets are incredibly important to community stability, and figuring out strategies to reposition those assets and capture them so that they can be put to long-term community use is a deal I would love to do, but don't. And the same holds true for healthcare institutions as well.
Hospitals, it's the same.
Same scenarios. So the deal that we have struggled to do, but we're going to get across the line this year, is the first multi-investor domestic pool of guarantees from foundations. And these kind of structures exist internationally, but many of you probably are aware philanthropy in many ways is very disaggregated. We have very kind of siloed in unique goals. Never heard of that? I know.
Never heard of that.
So my life's ambition over the last couple of years has been to organize philanthropy around some sector level goals, very high level, housing, climate, and small business, and to essentially create an intermediated facility so that all of our customers will have a point to go to when they're looking for credit enhancement, and it doesn't require kind of knocking on 15 doors around the country. We could use some more partners in that facility. I've asked many of you for your time and expertise in contributing to it. But I think to have the facility launch at a scale that is meaningful to the sector and worthwhile to the partners, it needs to grow a little bit, so a lot of it. So I would welcome anybody who has thoughts on that.
Thanks, Kimberly. Joe, I wonder if you could, I want you to go next, but I wonder this question about, are there partnership, is there a downside to partnership? Is there something to worry about? Or maybe this question about how the relationship with the tenants and sort of, how do you manage that with multiple needs for multiple reporting scenarios? And
well, part of what we're doing, this relates also to the question about how do you measure success, is our partner, the Conservation Law Foundation, did get a grant from Robert Wood Johnson to do a longitudinal study of these neighborhoods and to look at what change looks like from the community perspective, which is really important. And it's actually very interesting research. They've sort of finished the first phase of that, and they're going to continue to do that, and I can share it with anybody who's interested. But a lot of interesting pieces came out of that. One of the things that surprised me was that when people in the community look at how they would measure the impact of change, the biggest factor to them was their sense of control over that. Their sense that they had something to say about how their community was changing was by far the most important thing to them. Not whether there was a grocery store, whether there was this or that, but that was really an important thing. And this research is also important because we don't want to make neighborhoods healthier by just moving healthier people in. That's not the point. Yeah. The point is, are we improving the health of the folks that are there on a long-term basis? And anyway, that's one of the projects, just to answer your other question about projects we couldn't do and we'd like to do.
Yeah.
We had a suburban project, which it turned out didn't pass the neighborhood screen. It was doing mixed income housing, mostly affordable, in a suburban community right next to a commuter rail stop. Didn't have much affordable housing, but it was no health problem in the neighborhood. And I think we've decided that part of, in the fund too, that concentration of poverty is a fundamental part of this, and to the extent we can provide housing in suburban communities, that's a good thing. Even though we're not improving the health of that community, we are really helping alleviate the issue of concentration of poverty, and we're sort of trying to get our heads around that and how to talk about it.
That's really helpful. Kim, I think we're going to shift to the last word. So we'll start with you, and we'll go down the line here. But do you want to pick up any of those questions or go in a different direction?
Well, I wanted to say something about data and what is success, and this isn't the answer you want, but it's interesting for Equity with a Twist because we wanted to tee it up for impact investors. We kind of had, worked with we worked with an analytic group and came up with, I don't remember, 10 or 12 things that we wanted everybody to measure. And what we heard back was basically like, $2 million for 10 years at 2%, it's not worth it. It's really hard for groups to do data. And when you have funding for a longitudinal study, that works, but
Yes.
not everybody has that or can do that and is set up to do that. And so what we've tried to do is, as a CDFI at least, and I mean, we're not a university, but focus on the things you want to measure, like health or third grade reading scores, which is kind of a easy one to measure, or vacancy rates, if you're maybe, in terms of economic viability, and let them suggest how they want to measure it, and even self-reported data. I don't know if you view on this, but there's research that shows self-reported data on health is legitimate. And so finding ways to make it easier to for our partners to do those measurements is something that we've thought a little bit about, and it's going to be more important as we move forward and start collaborate more. So I would say that on data, and then I would say just generally, I think this is all really exciting. I think we're at a really exciting time in terms of community development and health kind of starting to work together and think about it, and there's language challenges and other challenges, but I would say just keep on plugging, and I think the housing conversation's important, but let's not forget those other determinants of health like early care and education. I'll put my plug in for that.
Thanks. John?
I know our time is short, so I'll throw out one thing that we haven't really focused on is policy, because ultimately, I mean, that's what is going to shape the, help the ease of the investments, help drive more funding, and so, one thing we're working on is a private-public partnership of mayors and CEOs in cities, and now I think the coalition is up to 32 different mayors, red and blue mayors, to stand together to advocate for more federal funding for things like HUD, connection between HUD and Health and Human Services, so that those things aren't disconnected, more grant programs to spark innovation. And another big lesson, I didn't know this, but it's hard to get Congress to do stuff. Real estate is messy, and Congress doing stuff is hard. But we've made decent progress, new sort of language. Funding is sort of being maintained, and we're getting some senators and representatives to kind of add this as a priority and building in some language. And then at a city level, how do we work with all the local, the counties and the cities to kind of make all of this easier in some way? And so we try where we can, where we have a decent voice or a good platform to kind of stand up for those things. And I think, how do we reunite our voices in a way to drive these sort of needed policy changes is something we're interested in.
And John, I'd like to make a point too, the role in which sort of the senior leadership of your hospitals are able to influence planning commissions and local, action mayors and whatnot. I mean, that you have a lot of weight because in many cases you're the biggest employer in some of the places where you operate, and so that's another important piece of this, the influence that you bring.
Exactly.
So that's really helpful. Joe, we got 1 minute.
I guess I would make an optimistic note that I think the hospitals are beginning to get it. I think in Boston, at least, I think it really is taking shape. There's sort of a whole movement among a bunch of hospitals as anchor institutions. There's this whole anchor institution movement almost among hospitals about the role that they play in the community. And some of our advocates within the hospitals are really taking a lead role in that and really pushing this agenda. We're having challenging conversations with some of the healthcare institutions about needing to spread when we manage money for them. But I think they really are beginning to get it, and I'm really optimistic that the hospitals, insurers are sort of a whole other thing, but I think the hospitals are really getting there, the treasury people. I mean, community health people get it right away, but I think we were able to sort of, break through that at Boston Medical Center, and I think the other hospitals were having discussions with the treasury people. We don't want philanthropy, really, because the philanthropy should go to the community-based organizations out there in the field. What we're trying to do is raise treasury money, and I think they are really getting it. I'm optimistic that we'll break through to significant investments by the hospitals.
I love that you mentioned that. I think the hospitals are meeting right now in Cleveland right now. In
There's
fact, for an
45 big health systems. I left, Kimberly and I left that meeting yesterday to be here today.
So my fantasy is to have this giant mashup. You know, we'll get the housers and the hospitals and the anchors, and just for my plug, a conference that Joy Hoffman and John Olson started many years ago at the Federal Reserve Bank of San Francisco. That's now an interagency banking conference. It's going to be held in March in 2020. And I'm hoping all of you come, and we're going to do our best to get as many of these different sectors there so we can have one of those mashup conversations in Denver in March. Kimberly, you have the last word.
If you buy my analogy that we're on a similar journey to the integration of health as we did with green, I put that integration at about a 10-year life cycle to really make it happen. I'd put health that we're like at year 5, so we better hurry up and get busy because the clock is ticking, and I do think the health sector is moving, but I think a sector goal should be to advance that faster.
Thank you, Kimberly. Please join me in thanking the panel.